If I started investing in 2026 with absolutely no experience, no fancy background, and no huge amount of money, I would do things very differently than most beginners. And honestly, that would be a good thing. Because most new investors make the same mistakes. They chase hype, they try to get rich fast, they buy random stocks they saw online, and they confuse entertainment with real investing. So if I had to start over from scratch in 2026, this is exactly what I would do step by step. The first thing I would do is get my financial life in order before investing a single dollar. I know that sounds boring, but investing without a foundation is like building a house on sand. If I had high-interest credit card debt, no emergency fund, and no control over my monthly spending, then investing would not be my first priority. My first priority would be creating stability. That means I would track every dollar coming in and going out. I would know exactly how much I earn, how much I spend, and how much I can realistically invest every month without putting myself under pressure. Then I would build a basic emergency fund, nothing crazy at first. Even 1 month of living expenses is better than zero. The reason this matters is simple. If life hits you with a surprise expense and all your money is tied up in investments, you may be forced to sell at the worst possible time. That is how people lose money emotionally, not just financially. Once that foundation is in place, the second thing I would do is automate my investing. I would not wait until the end of the month to see what is left over. I would pay myself first. If I could invest $100 a month, great. If I could invest $500 a month, even better. The amount matters less than consistency in the beginning, because the biggest advantage a beginner has is time, not brilliance. Now, if I were starting in 2026, I would keep my strategy incredibly simple. I would not begin by trying to pick the next big stock. I would not pretend I am smarter than the market on day one. Instead, I would start with broad, low-cost index funds or ETFs. Why? Because they give you instant diversification. Instead of betting everything on one company, you spread your money across many of them. That lowers risk, reduces stress, and makes it easier to stay invested long-term. If I were building a beginner portfolio, I would focus on funds that track the overall market. I would want exposure to large companies, maybe some international markets, and depending on my age and risk tolerance, a small allocation to bonds later on. But in the beginning, simple wins. Complexity is overrated. Most people do not fail at investing because their strategy is too basic. They fail because their strategy is too emotional. And that brings me to the most important point. I would focus more on behavior than returns. In 2026, there will still be people online showing crazy profits, talking about massive gains, and making it look easy. Ignore that. Real wealth is usually built slowly, quietly, and consistently. The goal is not to double your money next month. The goal is to build a system you can stick with for the next 10 or 20 years. That means I would invest on a schedule whether the market is up, down, or sideways. This is called dollar cost averaging, and it removes a lot of the guesswork. Instead of trying to time the perfect moment, I would keep buying consistently. When prices are high, my money buys fewer shares. When prices are low, it buys more. Over time, that discipline matters more than trying to act like a genius. Now, if I had extra time and wanted to learn more, I would study individual stocks before ever buying one. But I would treat that like an advanced class, not the beginner course. I would learn how businesses make money, how to read basic financial statements, how to evaluate debt, profit margins, revenue growth, and management quality. But even then, I would only allocate a small portion of my portfolio to individual stocks until I had enough knowledge and emotional control to handle the risk. Another thing I would do differently in 2026 is stay away from anything I do not fully understand. If someone pitched me a complicated investment and I could not explain how it works in 1 minute, I would skip it. If something promised unusually high returns with low risk, I would be skeptical. If an investment only sounded good because everyone else was excited about it, I would slow down. Hype is expensive. Simplicity is profitable. I would also be realistic about what investing is supposed to do. Investing is not a replacement for income. In the beginning, your savings rate matters more than your return rate. If you invest $200 a month, your progress will mostly come from contributions, not market gains. That is normal. That is why I would spend just as much energy increasing my income as I would choosing investments. A raise, a side hustle, a better skill set, or a second income stream could dramatically speed up the investing process. And maybe the biggest mindset shift I would have in 2026 is this. I would stop asking what stock should I buy and start asking what system can I build? Because systems create results. A monthly budget is a system. Automatic investing is a system. Avoiding bad debt is a system. Long-term thinking is a system. And when your system is strong, your portfolio has room to grow. So if I started investing in 2026, I would not try to be flashy. I would not chase trends. I would not try to impress anyone. I would get stable, invest consistently, buy broad market funds, stay patient, and let time do the heavy lifting. That may not sound exciting, but that is exactly why it works. And if you are a beginner watching this right now, remember this. You do not need to know everything to get started. You just need to avoid the obvious mistakes and stay in the game long enough for compounding to work. Start small, stay consistent, keep learning, and let the process build your confidence over time. Because in the end, successful investing is not about being perfect. It is about being disciplined long enough to let simple decisions turn into serious wealth. If I lost everything and had to start investing from zero in 2026, I would actually feel pretty confident. Not because I could predict the market. Not because I know the next hot stock, and definitely not because investing is easy. I would feel confident because building wealth is not about secret information. It is about following a few simple rules better than most people. And the truth is, if you are just getting started, that is good news. Because you do not need a finance degree. You do not need thousands of dollars. You do not need to be perfect. You just need a plan that makes sense and the discipline to follow it when everyone else gets distracted. So if I were starting over in 2026, the very first thing I would do is stop thinking like an investor and start thinking like a builder. Before you build a portfolio, you build habits. Before you build wealth, you build discipline. And before you chase returns, you create stability. That means I would start by fixing cash flow. I would know my monthly numbers down to the dollar. Income, bills, debt, subscriptions, food, everything. Because if money disappears every month and you do not know where it went, investing will always feel hard. Not because investing is complicated, but because your financial system is leaking. Once I understand my cash flow, the next thing I would do is create a margin between what I earn and what I spend. That margin is where wealth begins. Even if it is only a small amount at first, that gap matters. Because every dollar of margin is a soldier you can send out to work for you. After that, I would build an emergency buffer. Again, not because it is exciting, but because it gives you power. When you have cash reserves, you stop making desperate decisions. You stop selling investments because of small emergencies. You stop living in reaction mode, and that alone can make you a better investor. Now, once that foundation is set, here's exactly where I would start investing in 2026 broad market index funds. That is it. No drama, no trying to outperform professionals, no trying to guess which company will dominate the next decade. I would buy the market. Why? Because the market allows me to own pieces of many strong businesses at once. It is diversified, low cost, and historically very difficult to beat consistently over time. Could I eventually invest in individual stocks? Sure. But if I am a beginner, I want a strategy that survives my inexperience. Index funds do that. And here is the part most people underestimate. I would automate everything. Investing should not depend on motivation. Motivation disappears. Systems stay. So I would set up an automatic transfer every time I get paid. That way, investing becomes default behavior, not a monthly decision. If I only had a small amount to start, I would not be embarrassed by that. In fact, I would be proud of it, because small, consistent investing beats waiting for the perfect moment every single time. People waste years saying they will invest when they have more money, then more money comes and they still do not start. The habit matters more than the amount in the beginning. Now let's talk about what I would avoid in 2026 if I were brand new. First, I would avoid financial content that makes investing feel like a casino. If someone is only talking about fast gains, moonshots, and massive upside with no discussion of risk, I would move on. That is not education. That is temptation. Second, I would avoid trying to time the market. Beginners think success comes from buying at exactly the right moment. In reality, long-term success usually comes from spending more time in the market, not from finding the perfect entry point. If I waited for everything to feel safe, I would probably stay on the sidelines too long. Third, I would avoid comparing my Chapter 1 to someone else's Chapter 20. Social media can make normal progress feel slow, but normal progress is how real wealth is built. Quietly, repeatedly, without needing to show off every move. If I wanted to level up after mastering the basics, I would start learning how businesses actually work. I would study earnings, cash flow, debt, valuation, and long-term competitive advantages. But I would do that from a place of patience, not ego. I would not buy individual stocks just to feel smart. I would only do it if I understood what I owned and why I owned it. I would also focus heavily on increasing income. This is something many new investors miss. A good investment strategy matters, but your ability to contribute more money matters too. If you can increase your income and keep your lifestyle inflation under control, you create more fuel for the machine. That can accelerate everything. And most importantly, I would define success correctly. Success is not making a lot of money fast. Success is building a repeatable process that keeps working even when life gets busy, markets get scary, and headlines get noisy. So if I started investing in 2026, I would do the simple things with extreme consistency. I would spend less than I earn, I would create an emergency fund, I would automate contributions, I would buy diversified low-cost funds, I would keep learning, I would ignore hype, and I would stay patient long enough for compounding to do what it does best. Because the biggest advantage in investing is not brilliance. It is consistency. It is emotional control. It is the ability to keep going when nothing feels exciting. And if you can do that, you do not need to be the smartest person in the room. You just need to be the one who stays in the game. That is how I would start in 2026. Not with complexity, not with predictions, but with a boring system designed to win. And ironically, boring is exactly what builds wealth. If I were starting my investing journey from scratch in 2026, knowing what I know now, I would ignore almost everything that beginners usually obsess over. I would not spend my time hunting for the next explosive stock. I would not ask strangers online what to buy. I would not try to turn a few $100s into a fortune overnight. Instead, I would focus on the things that actually matter. The boring, repeatable, high probability actions that give beginners the best chance of long-term success. So in this video, I want to walk you through exactly what I would do if I had to start from zero in 2026 as a complete beginner. Step 1 would be brutally simple. I would get clear on my numbers. Before investing, I need to know what my life costs. How much money comes in every month? How much goes out? What is fixed? What is flexible, and what can be reduced? Most people think they need more money to invest, when in reality they need more clarity. Because when you understand your cash flow, you can finally make intentional decisions instead of emotional ones. The next thing I would do is eliminate financial chaos. If I had high-interest consumer debt, that would become a priority. If I had no emergency savings, I would build some. Not because cash is the highest return asset, but because stability creates options. And options matter. A person with no margin is forced to make short-term decisions. A person with margin can think long-term. After that, I would set a realistic monthly investment amount and automate it. This is important. I would not aim for something aggressive that I cannot maintain. I would choose an amount I can commit to even in average months, not just good months. Consistency beats intensity when intensity is temporary. Once my contributions are automated, I would choose a beginner portfolio based on simplicity, diversification, and low cost. In 2026, if I am new, I want exposure to the overall market through broad index funds or ETFs. That gives me ownership in many companies rather than concentration in one or two names. It reduces company-specific risk and allows me to benefit from long-term economic growth without constantly managing every position. This is where many beginners overcomplicate things. They assume a smart portfolio has to look advanced. It does not. In fact, simplicity is often a sign of discipline. A beginner does not need 15 funds, 10 speculative stocks, and a strategy built around constant buying and selling. A beginner needs something understandable, affordable, and durable. Now let's talk about time horizon, because this is where investing becomes powerful. If I am starting in 2026, I would mentally commit to a long timeline, not 1 year, not even 3 years. I would think in decades. That changes everything. When you think short term, every market drop feels like a disaster. When you think long term, volatility starts to look more like part of the process. That does not mean market declines feel good. They do not. But if I know I am buying quality, diversified assets for a long-term goal, then temporary declines are not automatically bad news. In many cases, they are future opportunities disguised as present discomfort. If I were a beginner, I would also create rules before emotions show up. For example, I would decide in advance that I invest every month no matter what the headlines say. I would decide that I do not sell because of fear. I would decide that I do not buy something unless I understand it. These rules sound obvious now, but they become incredibly valuable when the market gets volatile and your emotions start trying to negotiate. Now, eventually, I might want to explore individual stocks. That is fine, but I would earn the right to do that slowly. First, I would build my core portfolio with diversified funds. Then, if I want to learn more, I could carve out a small percentage of my portfolio for individual stock research, maybe 5%, maybe 10%, but only if I fully accept that this is higher risk and requires more work. And if I went down that path, I would focus on businesses, not ticker symbols. I would ask simple but powerful questions. How does this company make money? Is revenue growing? Is it profitable? Does it have too much debt? Does it have a competitive advantage? Is management trustworthy? Am I buying a great business or just a popular story? In 2026 especially, I would be careful about noise. There will always be noise. New trends, hot sectors, dramatic predictions, fear-driven headlines, overconfident influencers, and endless opinions. But opinions do not build wealth. Process builds wealth. That is why I would also spend time improving my earning ability. Investing is incredibly important, but so is increasing the amount you can invest. Learning a valuable skill, negotiating your salary, building a side income, or starting a small business can all increase the rate at which you buy assets. And the earlier you do that, the more powerful the results can be. Another lesson I would follow from day one is this: do not confuse activity with progress. More trades do not mean better returns. More apps do not mean better discipline. More opinions do not mean more knowledge. Sometimes the smartest move is doing less, but doing it better and longer. If I had to summarize my entire beginner investing plan for 2026, it would look like this. First, build financial stability. Second, automate investing. Third, use broad, low-cost diversified funds as the foundation. Fourth, stay consistent through market ups and downs. Fifth, keep learning without becoming distracted by hype. And sixth, focus on the long game, because the truth is, investing is one of the few areas in life where trying to look smart can actually hurt you. The people who win are often the people who stay calm, stay simple, and stay invested. So if you are starting in 2026, do not wait until you feel perfectly ready. You probably never will. Start with what you have. Start with what you understand. Start with a system that is realistic enough to survive your real life, and then give it time, because time, consistency, and discipline can make ordinary decisions look extraordinary years later. That is exactly what I would do if I started investing in 2026. And honestly, for most beginners, it is still the smartest place to start.